Okay, we'll give a few more minutes. We're up to 30 something now. Oh, now we're down. Oh, someone's eating lunch. We're up or down. Okay.
Hi, I'm Anna. I'm with Direction Service. I'm on the development team over there. I get to work with Amy Walsh, who's on the EVDP board, and I'm so excited for today's topic.
Well, good. Thank you. Okay, we're 31 at the moment, so. Oh, just jumped to 35, so.
I feel like we're on some kind of telethon.
There it is. Raise your hand. More, more, more. There are 54 signups or 52, whatever I said earlier. So I'm not sure exactly how many people will show up, but I would guess it will be about 5 to 8 short of that. So that's why I'm going to let it roll up to about 40 or so, and then we're going to get started. And it is going to be recorded, so if you missed something, somehow you'll be able to catch those first few minutes again. But those will probably just be me filling time.
I have to come. I can just watch the
right.
Okay. All right, so it's 12:05. I think we're going to get started. So a couple things. My name's Joe Milan. I'm the EVDP board president. So I have a couple announcements. One is that the slide deck is on the Resource Center on the EVDP website, and resources 2021 folder there, if you want that. Also, we sent out a survey to all the members a little while back, and we'd really appreciate it if you responded to that. A couple key questions we really need for planning have been, what do you want to do about trying to meet the grant makers? Last year we tried to do it virtually, which had some mixed feedback. Do we want to meet in person? When do people think they'll feel more comfortable meeting in person again and socializing that way? Is that going to be in the fall here? Is that going to be January next year? Want to get your feedback on that. And also topics, as we're, usually we'd have our, big summer picnic, and we all have our, barbecue and talk and come up with topics and things like that. So that is a question that, are we going to have that? Can we have that? We probably can't. So, we need that feedback from you for topics for planning. And then the last one is that we are most likely not going to have meetings through the summer. I think quite a few of us are, well, quite a lot of us might be a little burned out on Zoom and meeting over Zoom, and actually going to try and take a little bit of a break. Okay. So if anybody have any comments on that, you want to throw out questions?
Hey, Joe, I just noticed in the chat, and I was having difficulty as well finding the slides you mentioned.
Okay.
Did you say that it was the Resource Center and then under Resource?
You go to the Resource Center, you click it, you get this menu of lists. One is folder is called Resources. You have to double click that folder and it expands.
Okay.
And there's all the resources by year.
Aha.
Then you click 2021 and you see the first one there is the 2021 EVDP planned giving presentation. Okay.
Excellent. Thank you. That secret password was the double click. It reads 0 items in that folder.
I know it's it's not the it is what it is.
Thank you. No, that's really helpful.
Okay. Great. Okay, so let's see, the chat, post questions in the chat if you want there. I'll be looking at them and trying to throw them out there. I don't know. Elena and McKenna can decide how they want me to do that. If they want me to raise my hand, interrupt, they want people to just say their own questions anytime. You kind of give us guidance on that one, okay?
Will do.
All right. So the little intro, I'm so good at this because I'm just going to basically read the what they gave me here. But Elena Fracchia is a wealth and philanthropic advisor at Columbia Bank. She does more than just wrangle financial statements. She serves as a point of contact and strategist for business owners, nonprofits, and individuals as they navigate life's transitions. Working with Elena, you will identify key financial decisions ahead and create a plan to address them. She believes in long-term financial success is rooted in thoughtful actions that in turn positively influence our businesses, communities, and families. And in addition to her role at the bank, Elena has been on the faculty at the University of Oregon for the past 6 years, where she teaches fundraising for nonprofits as part of the nonprofit management program. With over a decade of prior experience in the nonprofit sector, Elena understands the challenges of building funding streams, allocating resources, and keeping donors engaged. Okay. But mostly we know Elena because she comes to all the meetings and we've seen her and I bank with her and whatever, And
Just can't get rid of her.
and she's a
Man.
great presenter and we have a great time. Okay. McKenna Knapp there's McKenna in the middle there. She currently serves as the Philanthropy Director at the Fanconi Anemia Research Fund in Eugene. She has over a decade of experience in soliciting and closing major commitments, building and leading and motivating teams, increasing performance and exceeding metrics, and collaborating across complex organizational structures. And her strengths include experience in a $2 billion capital campaign, major and planned giving conversations, including 6- and 7-figure gifts, strategic planning, corporate sponsorships, annual giving, donor relations, and stewardship, as well as the recruitment and retention of staff, student workers, and volunteers. Her work is inspired by people who show up for life. I grew up with a real sense of that an individual can make a difference and that if you can, you should. That looks like that was a quote from David Frohmeyer, right? Okay, so go ahead, ladies, take over.
Awesome, thank you. It looks like we've been pinned to your screens. You really can't get rid of us. So McKenna and I are so excited to be here today. When we started hearing that you all were interested in talking about planned giving, I knew that this was the opportunity because McKenna and I often sort of get down rabbit holes on planned giving and talking about how can we get more nonprofits engaged in planned giving? How do we think about this strategically? And what are some easy ways that we can start doing this? And so our goal today is to share from both sides of our experience. As you heard from our bios, I work in the wealth management field. McKenna works in direct fundraising. We both have this passion for how do we capture that crossover from the wealth management world to the fundraising world. So our goal today is to talk a little bit about that. I would say for questions, we'll do our best to keep an eye on the chat while each other are talking, but by all means, Joe, if you see something, interrupt us or feel free to raise your hand. I'll also try to be watching for that. So I'm going to attempt to share just the slideshow. Somebody confirm, do you only see one slide?
Yep, it's good.
Awesome. Okay. So today we are talking two sides of the same coin, how fundraisers and wealth advisors work together to navigate planned giving. And I think the key here is that it is a partnership. That planned giving is something we're doing in teams. It's not something that very many nonprofits are doing on their own. And so I think realizing and understanding what resources are available to you, what this looks like for you specifically, we're going to try to address that. We know there are small nonprofits on this call, there are large nonprofits on this call. You all may be working across different areas of potential planned giving. And so we're trying to capture all of that and make you just dangerous enough with planned giving that you could get started whenever you're ready. Anything you would add to that, McKenna?
I think it's great.
Okay. So let's go on to our first slide, which is the start of understanding what is planned giving, or sometimes you'll hear it referred to as legacy giving. And one of my goals today is to share a little bit about the jargon words that exist, as well as some of the words that you'll hear on the wealth management side, because both terms are important, and you never know which one your donor is going to use, because your donor may show up and say, I want to talk to you about legacy giving. I want to talk to you about planned giving. I want to talk to you about my estate giving. They use all of those words interchangeably, so it's important that we understand and know what they're talking about. And one of the things that I've noticed, I teach this in my fundraising class, is my students and frequently folks in the nonprofit sector don't want to talk about the tax implications or the estate taxes or talking about people's deaths. And one of the things that I think is really critical to understand around planned giving is that it's charity forward. This is about an individual's charitable intent. This is about their interest in giving back to their community, giving back to your organization. And that is usually the front goal that they have. So we're going to talk a little bit about taxes today. We're going to talk about how do you talk to somebody essentially about their death and their plans for death. But what I want you to remember in all of this conversation is that this is a charity and philanthropy forward conversation. And understanding that charitable intent is always part of planned giving, and it's usually what drives the donor. McKenna, did you have anything on that piece?
Nope.
Which we're just going to
I
go
know,
back
right?
and forth on topics. So what this looks like is that essentially a donor is directing a piece of their estate to an organization rather than a family member. And this is not, planned giving hasn't been frequently used in the last 50 years. I would say in the last 10, we're seeing a significant shift towards planned giving, towards people understanding what that looks like, how this gets incorporated into their estate planning. And one of the reasons for that is we are on the verge of a massive transfer of wealth. In the United States, generations prior have been all focused on building wealth, establishing wealth, how do we grow wealth? And we're getting to that tipping point where families have amassed the wealth that will sustain their family and generations going forward, and there's money left over. So the next question many are asking is, what do we do with that? And that's where planned giving comes into play for individuals who are charitably inclined, where we can direct part of their estate planning towards the charity of their choice. And many times in this case, they're talking about and working with a professional advisor. So a lawyer, a CPA, a wealth manager, a financial advisor, all of those folks may play a role in contributing towards that nonprofit charity and helping this individual set that up. We'll talk about why do you need to know about this? If other people have got this handled, why do we have to talk about it? But I think understanding these core components of what is planned giving, what are we even talking about? A lot of this is surrounded around philanthropy, marrying together with this transfer of wealth that we're anticipating in the next couple of years.
I'll also add right there, as we're talking about the transfer of wealth and we're talking about these family dynamics that come into play as we're talking about, philanthropic partnerships through estates, the conversations that we have with our donors surrounding these types of gifts are quite different than the major gifts that we receive through liquidity, right? So being prepared to really be vulnerable and present with your donor is going to be even more crucial in securing the largest gift that they're capable of. So we'll talk more about that too. But the dynamic between the donor and the organization definitely shifts in these conversations.
Mm-hmm. So where does plan giving fit in your fundraising strategy? Many of you, especially those of you that are coming from a smaller nonprofit, may be thinking, how on earth can I add one more thing to my list? Why would I want to engage with this? What does this look like? And yet I'm also kind of intrigued by it, because every time I see a planned gift, it's a really large number of dollars that come to the organization. So we want to talk about, how are these gifts different? How do they get incorporated into your fundraising? And why might this be something you want to engage with? With the first one being, what makes a planned gift different than a regular donation? Your other donations, just because we call them planned giving, it doesn't mean your other donors or donations aren't planned in somebody's life. What this means is that it becomes part of their estate planning. It's usually coming out of a piece of their estate. And so they may have to work with an outside advisor. It may be required that they write this in a will, which can only be done by a lawyer. So thinking about, one of the major differences is usually you have to bring in that outside advisor, or more realistically, the donor has to bring in an outside advisor in order to make this gift happen. There are a few exceptions to that we'll share. But for the most part, they're looking at their big picture of wealth and the assets that they have, and they're directing those to you versus writing a check at your gala or sending in an annual donation, giving you a credit card, doing ACH, all of those things that we know our donors are doing frequently. It's part of their budget planning, but a lot of times planned giving is part of their estate planning.
Yeah, so to piggyback off of that, right, these types of gifts are just not transactive, right? These are types of gifts that take years and decades and lifetimes to, really get to the point that the donor is willing to have this conversation and even consider a gift of this capacity to your organization. So, when a donor decides, oh, I'm ready to open the door for these types of conversations, what they're really saying is, I want to be tying my legacy and my memory to your cause, right? So it is so much more dynamic and personal than simply writing a check at a gala, which is a wonderful type of giving too, but it really takes a special type of donor to make this type of gift. So I wanted to share with you, it's about 3% of donors who will make a planned gift in their lifetime, and most of us, right, will be supporting charities that we care about, but since it's only 3% of donors who are making this type of gift, it's really important that we're stewarding them accordingly. It's also really important to know that these gifts are typically larger, right, than normal cash gifts. And so the average size bequest in 2019 was $80,000. And most people who had one bequest in their plans had a second one as well. So the return on investment for you to be spending some time educating your board, really being out in the field talking about plan giving, it makes sense, not only for the financial security of your nonprofit right now, but also because the heart and soul of your donor is really tied to your organization. So it's in the best interest of us as humans to show up for our donors in this way as well.
Yeah, and one of the things that a lot of folks ask is how are planned gifts incorporated into the fundraising picture? So where does this fit? Is this a major donor strategy? Is this some other kind of, do we have to start up a whole new strategy? And what I would say is there's ways to have a separate legacy planned gift strategy, and there are ways to incorporate this into your everyday fundraising that you're already doing. One of the things that I would keep in mind as you're considering if this is right for your organization and how you want to incorporate this is to remember planned gifts can come from anyone, anytime. You don't necessarily always know that they're happening. And so there are tons of examples, and we're going to start seeing more and more of these because there are planned gifts being distributed to organizations where the organization doesn't even know the person or has no idea how they're connected to the organization. And so what we need to remember is every interaction with every donor is a potential planned gift in the future. It doesn't mean you're talking to every single donor about their legacy planning. It doesn't mean you're out, shouting from the rooftop that you're accepting planned gifts now. What it means is that in every one of our interactions, we want to show the gratitude and do the stewardship to support every single donor so that they feel welcomed. And sometimes planned giving is considered the major gift of the middle class, meaning that some donors won't be able to give you this major gift in their lifetime, but they could give it to you as part of their estate plan. And those are the donors that you don't necessarily, we wouldn't necessarily think like, oh, let's go talk to them about a planned gift. And yet maybe they have amassed a certain amount of wealth in their lifetime, and maybe they don't have kids or nieces and nephews that they're sending some of these dollars to. And therefore, there's an opportunity to be thinking about how they can support organizations they love and care about. And if you're one of those organizations, you may end up on that list. We're going to have a higher likelihood if we start talking about it with them and put it on their radar. So that's one of the things that I think is important to consider. And again, one of the reasons why we want fundraising professionals thinking about this and understanding how this works, because you all can be helping your donors plan for and look at the future of their giving. Not every advisor is out there talking about charitable giving. Not every one of them has the background that I have, where I'm out talking to people about their charity. One person mentions charity to me, I'm done. We're talking about planned giving. But that's not the case for every advisor in the world. And so a lot of times we need the nonprofits to help with that conversation. And this can really start to elevate how we do that in this community.
I completely agree. And that's one of the things that we'll touch on later, right? Is how important it is for us as frontline fundraisers to look at our wealth advisors and our philanthropic partners as donors themselves, right? So, I'm going to be taking Elena out to coffee, right? I'm going to be stewarding her and making sure that she knows the mission of my organization so that I am front and center in her mind when she is speaking with individuals who might be interested in a planned gift. And, many of us here work in small shops. So at the Fanconi Anemia Research Fund, which I call FARF, which is the worst acronym on the planet, there's 2 to 3 of us that raise about 3.5 million in annual funds per year. So I completely get it. It's really hard to get new streams of revenue in place and then persuade our boards why that matters, and then actually have the capacity, right, to follow through for that. And we really just need new systems to kind of seamlessly fit into what it is we're currently doing. So the good news is that you really don't need this comprehensive marketing strategy, right? And we don't need to be sending postcards out every single month, and we don't need these, flashy billboards across town, right? Like really what it comes down to is being comfortable having these conversations with wealth advisors, with your donors. It comes down to maybe putting a little blurb at the end of the hard mailers that you're already sending out, maybe putting a tab on your website, right? The drip marketing is really what's going to start to shift the dialogue in your donor community. And then once you have that one champion, really broadcasting that story so that people in your impact report are seeing that they can consider your charity in their plans as well.
We have a couple questions.
Sure.
Yep, I just saw that one. So the one question, that does the 3% figure vary at all depending on the type of nonprofit, faith organizations, for example? I would say McKenna, you might have a specific answer to that. A lot of times these gifts come from your most passionate people who care about what you're doing. So they may go to specific types of organizations. I would say maybe higher ed is a pretty popular one because they're out actively talking about planned giving. But it's not the only place. And the figure that I keep an eye on is the Giving USA puts out a report every year. We're going to keep an eye out for some of these numbers that are going to show up in June for 2020, because 2020 was a real interesting year. And that would be something that we're seeing, that percentage of gifts going towards these planned giving opportunities increase. So the type of organization, does it have to matter?
So faith-based organizations, like when we're looking at the giving reports that have come out in the past, right? Again, 2020 is such a weird year, but faith-based organizations really do have very loyal supporters, right? And so I would assume that the number would be a little bit higher, just like higher ed, because people are used to giving to faith-based organizations, right? That's a part of what you do when you're in a faith-based community. But I think the 3% is right across the board. That's a standard. And the other piece that is pretty important to remember is that fluxes through the years, right? So when we see recessions happen, people are less likely to be thinking about their long-term wealth, right, and how they're going to be giving that away. They're going to be a little more protective. The exception being last year, right, where people were really confronted with, oh my goodness, right, life is not permanent, right, and so what will my legacy be, when it does end. So stay tuned for more stats about that. But yeah, the 3% is more, across the board.
Yeah. And Leah asked does it help having someone on your board who's a wealth advisor or similar? It may or may not. You don't necessarily have to have that role. I would say find people that you can connect to and ask how they are incorporating these into conversations. Ask what their clients are asking them, because that can help you in figuring out what do you talk to your donors about. Because the advisors aren't necessarily telling them which organizations to go to, but if the client is coming to you and saying, hey, I'm kind of trying to figure out who's an organization that does this kind of stuff, it is helpful if those advisors know what's going on in the community. Many of them will not just give a recommendation on a single organization, and that's just sort of the nature of the work. But being on folks' radars, helping them understand where, how to find you, if they have a donor that's looking for them, or knowing that you could work with that advisor if you had a donor that was interested, is another opportunity. So I want to keep us moving. We're going to talk about the big, scary tax conversation, but I want to provide a little disclaimer. Number one, neither McKenna or I are tax professionals. So there's a good chance we're going to say something that's just a little off. Two, you're not needing to be a tax professional in order to do this work. However, we need to understand just a little bit about how taxes work in order to understand how this plays into decision-making for your donors. And there's really three types of taxes that have charitable incentives, charitable giving incentives. And most of us are familiar with income taxes, where the higher the person's income, the higher the marginal tax rate of the income exceeding a certain limit. And so a lot of times, and I see this all the time with nonprofits, where we talk tax forward, like you're going to get a big tax benefit from giving us a donation. Here's what I'm going to tell you. In the Pacific Northwest specifically, the majority of donors are not giving to organizations because of the tax benefit. They actually don't care about it. And so all of that marketing that we're doing talking about taxes is not landing with the donor. It's not their top priority. And part of the reason is because it's not that big of an incentive. It doesn't incentivize every donor the same way. So it's entirely dependent on their taxes and how they manage their funds. And so you may be saying there's a big tax incentive, and then they go to do their taxes and nothing happened. And they could come back to you and go, hey, wait, you said there was benefit to this. So understanding that taxes are really complicated, they're very personal. Some donors may benefit, and there may be a charitable incentive to giving from their income. But I would say that's not the main reason they're giving to you. The second one are capital gains. And this one's kind of interesting, where somebody buys an asset and then sells it for a higher price. And the difference in that price is the capital gain. We all have to pay taxes on that. So if you buy a house for $100,000, or maybe like 10 years ago, you bought one $100,000, you put it on the market today, we're probably looking at $200,000 plus for that. So that $100,000 difference, that's the capital gain. As an individual, you have to pay taxes on that. As a nonprofit, you don't. And so understanding that the donor could gift you a capital asset, where if they give it to you outright, you as the nonprofit don't have to pay the taxes, where the donor would. So sometimes, depending on how they're structuring their estate, it may make more sense for them to give a capital asset to a nonprofit to reduce their estate, their total estate value. This is where the taxes start to get really complicated and people's decisions around their estate planning get complicated. This is when your donor needs a CPA on their team. Don't try to talk taxes with your donors, please. Bring in a CPA, rely on the experts, because they're also the ones that are going to look at the full picture for the donor and help them strategize on what makes the most sense, which asset makes the most sense to pass to the nonprofit. And then the question of, can you accept that asset? Meaning, can you manage it? So we'll talk about that a little bit later, how to know what works for you. But understanding that the capital gain, if they gift you the asset, you don't have to pay the capital gains taxes as the nonprofit.
So
then,
I also,
go ahead.
sorry about that. Yeah, so I also think it's important for us to note, and guys, in the slide deck, actually, when you download it, most of the notes of what I'm sharing, I actually put in there so that you can use similar language with your board or your executive director, or anybody moving forward. But I think it's really important for us to pause here also and say that, you know, it's $11 million right now for estates for an individual and 22 for a couple, which is a really small percentage of donors, right? But through some of President Biden's, new initiatives, he may be reversing that back to $5 million. And then the state of Oregon has $1 million threshold as well. So those are numbers that, as a fundraiser, although we're not tax professionals, we do need to have in the back of our mind. And really $1 million is not uncommon for some of our mid to high net worth donors. So I put a little example in the slide deck, and I'll just kind of read through it with you. I hope that it kind of puts things into perspective, giving an example like that. So, we have two donors. We have Joe and Dixie, and they got married in 1970 and bought a home in Eugene for $175,000. Joe retired from University of Oregon in 2001, and Dixie worked for the 4J school district until 2005. They both had those jobs for their entire careers. They had one son who graduated from U of O Law School and went on to be a very successful attorney in California. And let's see, they've been married now for 51 years. And in that time, their $175,000 real estate investment is now appraised at $850,000. So in retirement, Joe really enjoys investing in stocks and startups, and Dixie really likes to spend time volunteering with nonprofits throughout Lane County. They're both PERS Tier 1 retirement, which means that their income will remain quite comfortable and stable for the rest of their lives, right around 75% of their working earnings. And so when you look at Joe and Dixie, right, you might see a really humble couple. And yes, they are humble. But when you put on your planned giving lens, right, you don't have to look too far to see a couple who has been deeply embedded in the Lane County community, right? They have a son who is financially independent. And then they also are right around that $1 million threshold, right? And so that is when, as a development professional, it's important for us to start having those emotional conversations with our donors, right? We're never leading with the tax benefit, we're leading with the emotion and how much they care about our organization. But the mutual benefit there is that they're avoiding some huge taxation of their estate upon their passing. And we're also able to, talk about how capital gains comes in to play. So again, those conversations are going to be led by their wealth advisor. But as the nonprofit, you can really, encourage them to explore that option if the conversation leads you in that direction. So I just really, really encourage you to, connect with people who care deeply about you. And then you have to ask, right? People are not going to be bringing these conversations up, and there's no amount of persuasion that is going to, make somebody consider a gift through their estate. It is deeply personal, deeply emotional.
Mm-hmm. And I think, to that point, I would say 9 out of 10 of the estate tax conversations I'm having are conversations at that $1 million mark for individuals who plan to live and retire in Oregon, because it is a common marker, and most people don't consider themselves a millionaire. But when we start to add up the value of a home, the value of a retirement plan, maybe even if they have life insurance in there or other things that start to add up, you can hit that $1 million mark pretty quickly for somebody who's had a really long and successful career. So they don't have to be a big investor in the world. They don't have to have tens of millions of dollars to be someone that's considering this, or to have some estate tax benefits. But again, it's important to understand that those limits exist. And right now, the media is frequently only talking about the federal estate tax level, which, as McKenna said, is super high. It may come back down. We really don't know. But for Oregonians, we do need to consider and have conversations because we are one of 3 states in the US that don't follow the federal tax level. We have a much lower threshold. Washington is another one, and I believe New Jersey. And it's just this one thing that we have to make sure people understand and know about, because they can surprise themselves with the amount of their estate. So again, work with CPAs, work with the advisor of the donor, help them understand and I would say there may be some tax benefits, there may be some tax efficiencies that they could consider, but don't talk about it as a guarantee, because it's not a guarantee for everybody. And that's the big key with talking about taxes. So we're going to get off taxes and we're going to start talking about what are some of the types of gifts, because this is the fun stuff. This is the questions that folks have is like, what exactly is a planned gift and how do these work? And again, we're not going to make you experts on these things. I'm going to make you have just enough information to know what's out there for your donors. And that's really the key that we're aiming for here today. And so we're going to break out these gifts into what are called testamentary gifts, deferred gifts, and outright gifts. And there are different reasons that donors would choose any one of these types of gifts. And McKenna is going to share some examples along the way of donors that she's worked with. But this first category and grouping are the most common strategy. And these are gifts that are revocable. So meaning the donor could set up a testamentary gift and change their mind later, which is one of the reasons this is a very common practice, where they can be really passionate about your organization today, and they can write you into their will, for example, and then maybe some years down the line, something's changed in their life, they can change their mind. So it feels less permanent to the donor if they're making this choice. These are usually promises that donors make for a future gift. So in the same way that they can change it, they usually don't, or they frequently don't, partially because people aren't updating their estates that often, but also partially because they feel that this is an important promise that they've made to you as the organization. And importantly for you to understand is the organization does not see any money today. They only see the money after the donor passes away. So the 3 types of gifts in this category are if a donor makes a bequest in their will. So they write you as a beneficiary. And I would say a will or a trust, because both of those can be true. And wills and trusts work a little bit differently, and you may hear those words used interchangeably. They essentially do the same thing, but they work differently. So they can write you as a beneficiary, just like they would write their kids. You could get a percentage, you could get a dollar value. So those are 2 ways that a donor can write you as a bequest into their will. It's a very simple, straightforward way for them to give to your organization. That is the #1 most common way. These other 2, life insurance and retirement plans, are not used as frequently, but I would say with the caveat that they're being talked about more. And this would be something to keep an eye on. And this is where, let's say somebody got a life insurance policy young in life when they had young kids, they want to make sure they protect their spouse. Maybe it's to cover the cost of a mortgage, something like this. Usually not as frequently, it's a term policy, but instead it's actually a whole life policy that has some cash value. The donor could, instead of writing either their spouse or their kid as the beneficiary of that life insurance policy, they can actually write an organization into that. So upon their death, you receive the value of the life insurance policy. A donor that does this is a donor who their family or whoever they initially were trying to protect by purchasing that life insurance policy is either financially stable, as we talked about, or they've amassed wealth in other ways that life insurance policy is no longer a key part of their legacy they're trying to give to their family, so they can give it to your organization. Same with a retirement plan. We all put money into our retirement plans and constantly think we work our whole lives towards retirement. And then at some point in time, some people have, again, amassed enough wealth and assets that retirement plan that they were giving into isn't necessary as part of their legacy planning towards their family, so they can write an organization in as a beneficiary of a retirement plan. So those are a couple of ways. And again, it's a function of you're the beneficiary of that plan. You would only see the dollars if that person passed away.
Yeah, so, by and large, the majority of plan gifts that I work with are testamentary, right? Probably 75% of them come through wills or trusts. I would say the majority probably through wills instead of trusts. And then probably 5% through life insurance or retirement plans. I will say that the life insurance and retirement plans can be larger gifts than through your will and trust, because typically through wills, people are breaking out into more charities or more areas to give, like family members, etc. And then probably 20%, that extra 20% would be in deferred or outright gifts, which we'll talk about next. But testamentary is so awesome as a fundraiser to talk about, because you're really asking for a gift that is not going to create any financial ripple effect for your donor, right? So it is putting your mission first and saying, hey, you care so deeply about our cause. We care so deeply about you. Would you consider a gift like this? And then they get to say yes, right? And they get to be treated and stewarded as a major donor. They get to be included in your promotional material. And it's a really sweet experience for the donors. And they have no financial ripple effect, right? So they are not losing out on any quality of life, during their lifetime. So, for anybody who is new to the plan giving conversation, I really encourage you to get comfortable with these testamentary conversations. And I wanted to share one of the first stories with a gift like this that I worked on. It was a set of identical twins. They were both widows and very modest women, both educators, and they wanted to make a gift to their alma mater in honor of their relationship, right? And also to inspire the next generation of students, right? And so in working with them, I was able to learn a lot about their family dynamics and what they cared about, and really understand where they were at in terms of their entire giving portfolio, right? So it unlocked also conversations for liquid gifts later on, because I understood really where they were at in terms of their finances and their capacity and desire to give. So, that was one of the first gifts that I worked on in this space, and it will always be so near and dear to my heart because they were just such a treat to work with. But we worked together for several years before we actually got that gift committed. So, these gifts do take some time, but they're worth it. They're worth it to the organization, so you can project your funding, and they're definitely worth it to the donor. So keep up the good work.
Yeah, and one of the things we mentioned earlier is how does a donor do this? Again, you're going to send them to their advisors, but with this particular set, interestingly, the only one they actually need an outside advisor is the bequest in a will, where they would work with their lawyer who's drawing up their will to put you into the document formally. That's how that happens. For life insurance and retirement plans, if they're making you a beneficiary, they're updating their beneficiaries usually on an online website, which, by the way, if any of you haven't updated your beneficiaries recently, it's a good time to go check that out. Make sure you update your beneficiaries frequently, annually. You want to check on those. But in this case, individuals can go in and just update the beneficiary. It doesn't take an outside professional to do that for them. So sometimes that's another reason that's a real simple process for them. Okay, our second type of gift is considered in the deferred gift category. And these are gifts that are irrevocable, meaning they can't be changed. The donor makes the decision at a given point in time. However, they're deferred because they're given today, but you don't see anything for the future. You'll know how much of the fund, you'll know how much the funds are going into the fund here, but not necessarily what's available to the organization until the donor passes away or until the agreement that they've set up is extended. The dollar amount at that point in time is determined on that date. So I've put in here on the slide at the date of the donor's death because that's the most frequent. But with something like a charitable remainder trust, they could set that up for a 10-year, 20-year period. And then at the end of that 10 or 20 years, that's when you'll know the value left. So how these two things work, and again, I'm not going to get super in the weeds on how these work, because these are ones that either your organization does them or they don't do them, or you're sending them to an outside advisor. And these, I would say, are some of the more complicated ones. And these are for donors that are looking to establish an income stream, but also charitable in their intent. And so they're moving dollars out of their estate into a charitable gift annuity or a charitable remainder trust. And these two actually function the same, they're just held in different places. So they're going to put it into that mechanism. And then during their lifetime or the term of the agreement, they're actually receiving income back. And that income doesn't count as part of their charitable tax deduction, but it's actually income to help them live and exist in whatever way that they see fit. At the end of the term of the agreement, whatever is left in that account goes to the nonprofit organization of their choice. Sometimes they're choosing multiple. The difference between these two is the charitable gift annuity is actually held at the nonprofit itself. So this one's really interesting. This would be a very sophisticated nonprofit who is engaging. You've got someone on your team that is managing the investments of the account, who is making sure the donor gets paid, who is making sure that agreement is upheld. I am not familiar with very many organizations that engage with this. I think some of the larger foundations do, but for the most part, I think it's good to know these exist and understand they're not for most nonprofit organizations. The advantage of them is that you're managing the dollars, but again, they're not really your dollars until you know that final amount. Charitable remainder trust functions the exact same, except for they're putting the dollars in trust with a professional advisor, whether that's a trust company, a financial advising firm, any of those things could be an option. And the ultimate dollars that are in trust are for the charity, but during the lifetime of the donor, they're getting a payment. So these are more complicated ones. These are usually donors that are really doing a lot of planning. They're trying to figure out both cash flow during their lifetime, but also maybe doing some estate planning and tax efficiency planning. So these are going to be pretty sophisticated donors that are looking at this option.
Yeah, so in my tenure as a fundraiser, I've had two donors ask me about these types of gifts, right? And I've worked with thousands of donors at this point. So, I think it's important to know that you should always push your donor back to their wealth advisor for this, unless you're in a really, really big shop that has attorneys and wealth advisors and, everybody who can help you set these accounts up. I mean, if you just Google what one of these looks like, it's enough to make your head spin. So I really encourage you to always put that back on the donor. And then really as a fundraiser where we can be very powerful, right, is to then designate the funds of the donor once those gifts are committed. So to sit down with Joe and to say, hey, I know that you care about this at my organization. Is this where you would want your funds designated, right? And to customize the donor experience in that way. So I really, encourage you to push that back on the donor. And then also to be working with your wealth advisors to make sure that, again, you are front and, foremost in their mind when they're talking to these people who are considering more complicated deferred gifts.
Yeah. So ones that you may see or you may be familiar with that are considered outright gifts. These ones are also irrevocable. So once the gift is made, it's permanent, it cannot be changed. These are considered outright gifts in that they're given today and you receive the dollars today, or the mechanism they use receives the dollar ticket today, which is donor advised fund. We'll get to that in a minute. In this case, the charity knows the amount and they can use it immediately. And it's arranged on the front end. So how these ones work, and these are all very different in an outright gift. So the appreciated property, we talked about the capital gains taxes, where a donor might give you their house. And this could be that they make the outright gift today, where they're like, we're moving, we're done with the house, we don't want to deal with this. We're giving you, nonprofit, the house, you're going to sell it, liquidate it, and then the value of the house is the value of the gift. And that one is kind of interesting as it's considered an outright gift, because a lot of times we actually see those in more of a deferred model, meaning they're putting it in their estate, but ultimately you still know that that's happening. There are some cases where the donor could give you appreciated property, but set up a contract where they're allowed to live in it until they pass away. Again, you would have to decide if this is something that you can manage. Donor advised funds, I think many of us are familiar with those. Donor advised funds are utilized where the donor puts in a large gift in a single year into a donor advised fund and then allocates the dollars out over time. So it's considered an outright gift because as soon as they make the gift, then it's out of their hands, it's irrevocable. They can't take those dollars back and they need to be utilized for the purpose of the donor advised fund. But in the sense of, will you see that full dollar amount today? Not necessarily, because they're going to allocate it over time. Donor advised funds can live at, I think many folks are familiar with Oregon Community Foundation. They also can live at financial advising firms. If they manage those, they can be part of a trust company process and work. So there's a number of advisors that utilize donor advised funds or offer donor advised funds. The one that I think this community is most familiar with is Oregon Community Foundation. And those donor advised funds, we're seeing an increase in the use of those. And some of that is because of the gifting on the front end, and yet the donor's not quite ready to give that whole amount in that year, but they would like some of the tax benefit of the whole amount. So that's essentially how those are used. And then the final one, again, not to complicate things, a charitable lead trust works very similar to a charitable remainder trust and your gift annuity. However, instead of the individual getting paid during their lifetime, the nonprofit gets that payment, and then they designate who gets the remaining. So it could be a family member gets the remaining. So it's kind of the opposite effect. And the way that I remember these is in a charitable lead trust, you get the lead dollars. In a charitable remainder trust, you get what's left over. You get the remainder. But they function, they work the same. It just is a difference of who's getting the income stream during the life of the donor versus who gets the remainder.
Yeah, you know, these outright gifts, I can, oh, we're getting feedback. Do you guys hear that feedback?
No.
Well, just me then, great. You know, these outright gifts are definitely one of the outliers for planned gifts. You know, DAFs are probably the most common, right? But there's a lot of bang for buck with these types of gifts, and typically they're donor led. So the donor is going to come to you with this option more so than you're going to be soliciting this type of gift. And so I wanted to kind of paint a picture for you what the appreciated property conversation can look like, because I think that's probably the most mystical out of these gifts, because we really don't see a lot of donors gifting property, right? So I'd worked with a donor for quite a while, had great working relationship with her, and she had a family member pass and leave a piece of property to her, right? And this donor had 2 properties already, really didn't need this other property, but she wasn't ready to sell the property or to move forward with getting rid of it. So because we had a great working relationship, we were able to have the conversation with, hey, you know, you can avoid some capital gains because the family member had purchased it a really long time ago. And, you know, now it's, you know, in the mid 2010s, right? And so it could be of mutual benefit, right? To honor that family member who had passed, to get rid of the property, and also to make an impact on the charity that she cared about. And so these conversations, again, are long, right? These are not going to be overnight decisions that your donor is going to wake up and be like, yes, this is exactly what I want to do, right? But just kind of having the background knowledge of how these different vehicles work is what's going to give your donor the confidence that you are able to handle the conversation and that your charity can accept that type of gift. We'll talk a little bit more about that, I think, on the next slide.
Mm-hmm. Yeah. Let's talk about accepting gifts. If any of you have ever met with me about your investments or gifting, you probably have heard me ask the question, do you have an investment policy statement? That's my favorite one to ask, but also we want to talk about a gift acceptance policy, because these two policies frequently go hand in hand when we're talking about planned giving, and or that's the time that you suddenly need that policy in place. And if we haven't talked about it and we haven't considered it, even a generic version of it, then you have to have that conversation. It could slow down the process. So there's two types of policies that are really helpful for your nonprofit organization, for your board to be having these conversations and your board to be considering. The first one is a gift acceptance policy. And the purpose here is to determine what types of gifts you'll accept, who has the authority to accept them. This is really critical, and I'm going to talk about that here in a minute. Who will draw up the contracts with the donors about those gifts, and under what circumstances the organization will accept or decline a gift. Imagine if you have this policy in place, if you even put this on your website, this is our gift acceptance policy, particularly around planned gifts, you can make it really clear to your donors, these are the types of gifts we can handle, these are the ones that really we can't handle, and you would have to get an outside person to manage it. So that could be selling a house or liquidating stock or any of those types of things, making sure that you have this policy. And as I said, the critical one here is who has the authority to accept them. Now, I know there's some board members on this call, so I'm going to talk directly to board members and to some of the leadership in nonprofits, understanding how our board members work. Because what happens here is, as board members, we get so excited about our nonprofit organization. Hopefully we're out talking to every single person we know about this organization, what they do. You've just attended this really awesome planned gift presentation and you learned so much. So now you're going to go talk to all your friends about their legacy planning. Here's the key for the nonprofit is board members, really, we don't want them out accepting complicated planned gifts on behalf of the organization without having that conversation with the team on whether or not you have the capacity to manage that gift. So this is really where the who has the ability to accept the gift is important. We want board members out talking about this. We want them out having conversations, but they may get excited and they talk to their friend who, one of the gifts that I've seen out there is they have a vintage car collection and nobody in the organization has the ability to value the cars, figure out who you're going to sell them to, how that works. It would be so much work on the organization, and that might not be appropriate. So understanding what you can and can't accept, who has the ability to determine if that's a gift that is acceptable, and when do you accept them, when do you need to decline them. If you're really clear about that on the front end, it's a lot easier to decline gifts that don't make sense for your organization, because otherwise the things that get in our way are we see the dollar signs and the potential. And so you get hung up in the, ooh, that could be really fun if we could just figure it out and stretch our people to the max who are already stretched. This is where a gift acceptance policy can be a good little backstop for everyone to be on the same page of what's appropriate to accept and not accept.
You know, I think the single most beautiful thing about the gift acceptance policies for the development professionals in the room too, right, is to be working with your executive director and the board to find that mutual ground that feels okay for all of you. Because once we are at a place where we're all in agreement about what that looks like, your job is simply to go raise money, right? You don't have to be worrying about, oh, am I accepting a gift that is in conflict with my organization? On the slide deck, you'll see that I included 5 different things to really consider. One is compatibility of cause. The next is public relations, the form of gift, source of gift, and the obligations or encumbrances. And it's just really important to have an open, honest dialogue, kind of recurring, honestly, as these different types of gifts are coming up. Our board talks pretty regularly, probably 2 or 3 times a year, about how we're going to accept gifts, what that looks like as our planned giving program changes and evolves. And I think it's really, really important in any sort of gift acceptance or investment policy to always include a little tidbit that the board of directors and the executive director can change their mind at any point, right? So dynamic gifts must always be approved by the board of directors before accepting, so that you have the ability to decline any financial commitment, but also that the organization can reallocate those funds, right? So just making sure that we have these clauses kind of built into our documents so that your job as a fundraiser is just to raise the money, right? That you're not going out there trying to figure out where the line in the sand is for your organization.
Yeah, and Mary's asking, do we have a sample gift acceptance policy and who would we recommend has the authority to accept? I generally direct people to the Council of Nonprofit Governance. Am I getting that name right? Council of Nonprofits. They've got great resources for both of these policies, actually, that talk about what are some of the questions you want to ask as a team. And then they provide examples from various organizations around the US who have created these types of policies in different ways so that you can see what's available. So for both the gift acceptance policy as well as the investment policy, I would recommend utilizing that resource. And so transitioning then to the investment policy, why on earth would we be talking about that with planned giving? And one of the reasons is simply because these planned gifts are or can be large amounts of money that maybe, and again, it's a one-time gift. It's not recurring income to your organization. So we need to keep that in mind. But the purpose of this policy is to determine how would you invest money? Would you invest money? So are you willing to do that? What components of the investment options is your organization comfortable with? What are you not comfortable with? And so the questions that you would consider are, what's your risk tolerance? What's the type and size of investments you would be comfortable with? What categories of investments? So if you're an organization and you're doing environmental work, you may have more specificity around the type of investments related to the environment. But ESG, environmental, social, and governance investments are a frequent conversation that we're having with nonprofits. And then who manages those? Yes, thank you, Joe. That is the website that I was talking about. And so thinking about if you were ever in a situation where you have funds, and right now, we all know the frontline banking options are pretty low interest. So if you're sitting on a ton of funds, have a conversation with your board about, are we comfortable with investments? Because that could be what you access and how you access higher interest rates, especially in a market like today. So this is something that we're talking about with folks constantly. And for nonprofits specifically, one of the reasons you're going to be asked this question is because investment advisors will go out and they will give you a proposal anytime you ask for one. But it's really hard for them to commit all of that time and effort to find you a really good investment that works for your organization without first having the conversation with your board. Because how this plays out is they go do all this homework for you, they do all of this work, they bring you all of these ideas, and one board member goes, I'm not really comfortable with that. And it all goes out the window. So we recommend that you actually have that conversation first. So the advisor's not bringing you anything that that you haven't already determined you've had a conversation and are comfortable with. And so these show up in planned giving really around large dollar amounts that you want to extend over time. And maybe it's more than the FDIC insurance that you have in your account. And so we want to look at other options. There's a lot that goes into that, but I would say, check out those resources on the Council of Nonprofits, see what they have. This could be a good conversation to have with your board because it could be a full stop for the investment advisor if you haven't had that conversation first. All right, I want to be mindful of time. McKenna, we have 20 minutes. Okay, so our planned gifts, sorry, not investments, I got off track. Planned gifts right for your organization. Some of you may be hearing all of this and going, oh my God, this is way too much for us to consider. So how will you know if this is right for you? One of the things that we want you to consider and have this conversation with your board is, again, what level of engagement will you have? That drip marketing that McKenna talked about, where you have something on every piece of marketing, every newsletter that you send out that says, consider us in your estate planning, talk to us if you have questions about your estate planning, or something along the lines of, if you've written us in your estate, we'd love to know about it. That sort of makes the assumption they've already done it, and maybe you're planting the seed for them, but just planting those seeds could be sort of the lowest common denominator of getting into this conversation and starting it, see what happens. But deciding what makes sense on where to start, I think, is important. Don't start with the charitable gift annuity. That's like way on the end once you get really into this and start nerding out on planned giving. And even then, you still might not want to do that one. Start with the things that are easier, that are the bequests, that are the writing somebody, having them write you into their beneficiaries, things like that.
Yeah, so remember how I mentioned the 3%, right? 3% of donors will consider this type of gift. Well, only 40% of people in the United States actually have a will, right? So another really easy way to start these conversations is to, think about partnering with an organization like Free Will, where your donors can establish their own will online, and it has a charitable lens to it, right? So just to know, right, that we're marketing towards a very niche community, and that it's going to take some time too, right? So just being patient with that, right? Providing resources to our donors, being open to the conversation, and then ultimately just having an active listening ear for when they're ready to make that commitment.
Mm-hmm. Okay, so McKenna has provided some examples. So just let me know when you want to change slides here, but
Yeah.
I will start putting these out if you could walk us through what you've got here.
Sure. So before we get started, if anybody is curious to either like go through different planned giving questions that they have, or see any other promotional material that FARF has created, I'm happy to do that with you offline. My email will be on the last slide. I'm a huge advocate for not recreating the wheel, but really like customizing materials that are already out there to your own nonprofit. So there's that. But I do want to kind of share what I do when a donor approaches me about this type of gift, or I ask them to consider this type of gift. And the first document is the statement of testamentary provisions. And so once a donor says, yes, I want to make a planned gift, you pull out this one pager. And so basically on this one pager, it will outline at a very high level, what type of gift the donor is considering, the value of the gift. Like Elena mentioned, you can get percentages or dollar amounts. I always encourage a percentage because it really gives you a different insight as to the overall capacity of the donor, right? If they say 20% and then you say, okay, what does that mean dollar-wise? You get a much clearer picture of what their liquid ability to give might be until their death, right? And then also their preference for publicizing the gift. So if they want to be anonymous, if they're okay with us sharing their name, if they're okay with us sharing their the dollar amount attached, and then also their very high level preference for giving. So at FARF, it could be science, family services, or unrestricted, right? And so in that next document, we would outline kind of in more detail what that could look like. So once this, once this document is signed, as the philanthropy director, I consider the gift locked and loaded, right? So at this point, I'm going to take that percentage and that dollar amount and put it into a separate budget line item. I'm not going to include it in the normal budget, right? Because it's not liquid assets. It's not confirmed money that we can absolutely 100% count on. But I am going to make sure that those numbers are presented to the board so that they can see the fruits of my effort and they can thank the donor where it's appropriate. So we can go on to the next one now. So the second document is definitely for the donor and much less for the charity, but it is equally important, and especially for us small shops, really important that you have a pretty document to work with, because big organizations like UO are going to have beautiful documents. So when we say, oh, if one donor is considering a planned gift, they probably have a second one in their plans as well. We need, as small charities, to make sure that we are competing against the big dogs too, right? And a lot of that comes from the pretty marketing material. So, depending on the complexity of your organization, you might want to include other information than what I'm going to show you here. But But I do want to preface all of this by saying none of this is legally binding. It is really just a tool that we can use to formalize the donor's gift intent, encourage some confidence between the donor and your organization, and then really provide guidance for how the funds should be spent once the gift is actualized. So some of the common themes to consider, we can go to the next one now, would be to thank the donors. So obviously we're going to start with thanking. You're going to very high level kind of share what your gift acceptance guidelines look like, talk about the value of the donor's pledge. So on that one pager, you're going to get the percentage, right? But as you're going back to the donor to establish the second document, you can also say, okay, so Joe, you said we were going to get 20%. Can you give me, an estimated value for what 20% might look like now, right? So you're going to include as many details about what the size of the gift would look like as possible in that section. And then you're also going to be talking to the donor about their 3 preferences for making a gift. And it's really important to lean into preferential language here. Ultimately, the hope, right, is that when our donors pass, the causes that matter right now do not matter in 20, 30, 40 years, right? I fundraise for cancer research, and I really hope that in 30 years, when some of my donors pass, that cancer research no longer needs to be funded because we figured it out. But the reality is that it will probably still need some funding, right? And so in this preferential language, the donor is able to specify what causes at your charity they care the most about. I really encourage you to keep one of the 3 boxes unrestricted so that the board has complete discretion to be able to spend the funds how they see fit. But the preferential language gives you a lot of wiggle room there. So you can go to the next one now. So this one is a very boring slide, but it is the spirit and intent of the donor, and it's written by the donor. So this is the part of the agreement that's going to include a photo of them, and then the donor is going to outline their history and their desire to give and any other details that they want to share with you. Not a lot of gift agreements actually include this. And the reason why I encourage development professionals to do this now is so that you're in good graces with your marketing team when the gift is actualized. What's so beautiful about this is the donor has already written what they are comfortable with you sharing in the community to celebrate their gift once the gift is actualized. So it is just a really beautiful way for the donor to feel engaged, and it's a really easy tool for you to use for publicizing the gift later. All right, and the last page is where we're going to record the donor contact information, their lawyer's contact information, if that pertains, and then your charity's contact information. So in the future, if they want to make any amendments to the gift agreement, and because it's not legally binding, I encourage you to open that dialogue every 3 to 5 years. You will be able, as the development professional, to send a new copy over to their lawyer, a new copy to them, and just kind of take them out of being that middleman. It's a really nice stewardship piece to really make sure you're taking care of your donors in that way. So I try to revisit this entire gift agreement every 3 to 5 years to make sure that nothing has changed in terms of what they can fund or what they want to fund. And then other than that, once all of these papers are signed and everybody has copies, I really turn my plan giving donors into stewarding like a normal major donor would be, right? So I am connecting with them once a quarter or whatever, a meaningful amount of connection looks like to them. I'm including them in different, marketing material that's going out. I'm inviting them to events, but I'm really just putting them back into the major donor pipeline because you might get some liquid gifts out of, donors who are considering this type of contribution as well.
Yeah, these are awesome tools and resources, and thank you, McKenna, for sharing them with everyone to see as an example. A couple of thoughts that we want to leave you with here towards the end of this presentation is just some of those things to keep in mind, because again, these are big dollars oftentimes, which means we get excited about the number. But the reminder to just be cautious when we're counting on those gifts. So like McKenna suggested, have a separate spreadsheet of what you think is coming in. Don't put don't put like the date that you think it's going to happen, because usually that means we're thinking about the donor's death. That's not our goal. Again, we're just looking at how can we steward these donors in their lifetime, continue to keep them connected, thank them for those gifts, stay top of mind. Working with your advisors, our goal today is to talk about how and to share a little bit from both of our sides and points of view of what McKenna and I both see. We're working with your donors in very different ways. She's working directly with donors that understand and know FARF. I'm working with donors who I have no idea who their main charities are, only that if they bring up charitable giving, or if they see that on the list of things we're talking to them about, that we can have that conversation. So making sure advisors in your area and advisors that know about you, and asking them. I encourage folks to ask, how do you have charitable giving conversations? Are your clients asking you about this? One, because I have a personal interest in getting more advisors to talk about charitable giving, but also because I think it's important for us to, as a nonprofit sector, to start thinking about how do we put this and get this elevated higher. As donors are going to start hearing about it in the media, we need to also be a front end of making sure we're helping them think about it. And to lastly, always remember that planned gifts are the opportunity for your donor to show their ultimate support and passion for your organization. So really, these gifts are pretty incredible, and they truly can come from anywhere. You never know what that connection is. We, of course, always want to know who that donor is prior to their death. We can't ask them. We can't talk to them after they've passed away. The best you can do is talk to their like that, where nobody knew the donor. Nobody knew how they were connected to our organization. And they gave us a gift that equated to almost twice our annual budget. So it was a really incredible gift for us. And yet we didn't know anything about them. So the only way we could learn about them and their interests and what might have been their passions to figure out how we would direct the gift was to have conversations with their family. It would have been amazing to know who that donor was on the front end. It wasn't a luxury that we were afforded. So having these conversations, even in those really passive ways of just having it available on your website, having it available as part of your marketing and communications, really does help bring this higher to mind for donors so that they may come to you and ask about that. The other thing that I would add, and I've heard this in EVDP multiple times from various individuals, is that as donors are getting older, they're thinking about their legacy. We are often uncomfortable talking to them about their legacy because we think it's just death forward. It's not a death forward conversation. It's a charity forward conversation. It's philanthropy. It's their passion for your organization. So really shifting that mindset that planned giving is about continuing that legacy. If that's of interest to them, thinking about what makes sense for them. Do they have an advisor? If you've been out talking to advisors and knowing who's available and they don't have someone, you might be able to provide them a couple of names of people to talk to. So all of those things are really helpful in the grand scheme of planned giving.
I'll, just a final thought, right? Kind of the measure that we use on the fundraising side, and I'm sure many of you are familiar with it, is 10 plus gifts over 10 plus years, right? And some charities have been around longer than others, but it's important, right, to not be sending materials or having conversations with people who may have just made their first gift to your organization. But it's also important to not wait until a donor is 85 to have this type of dialogue. And so we're seeing younger people consider planned gifts. I had a donor that I worked with just last year who's 40, right? And she cares deeply about what we do and wanted to commit that. So I encourage you also to not take things black and white with planned giving. Really, it's a very fluid, dynamic conversation, and each gift is going to be so unique and personal to the donor. So you may be working with a 35-year-old and then an 85-year-old, and they may be completely different giving vehicles, and they may be interested in giving to different causes that you support. But just being flexible in your approach, and then also knowing that you can reach out to myself or Elena anytime you have questions. We're always here to work with our fellow fundraisers.
Yeah. Yes, I think I saw a presentation recently where the presenter said the average age that someone is setting up something like a donor advised fund is 56. and the average age of donors who are sort of allocating and putting money out through advised funds and starting those conversations with their family is around 65.
And most people are only going through a couple of iterations of their wills too, right? So that's really important too. So if you are able to get in on the first iteration of their will, you're set. It's less than 5% of donors who actually take charities out of their will. And so although it's not confirmed money that you should really be planning on, the likelihood that you will receive those funds if you're stewarding the donor appropriately is pretty high. It's pretty high.
And have fun with this. Talk with folks about the impact of your organization. Talk about what changes because of these gifts. Another sort of low stakes way to talk about planned giving without talking about planned giving is anytime you receive a planned gift, maybe a surprise one. So I think it was Leah at the very beginning who said she received a surprise gift from a former board member, is if you receive one of those gifts, celebrate it big. Tell everybody in your community about it and how much impact it has. It's a back end way to be talking about planned giving and how helpful it is and how grateful you are for it without going directly to your donors, but you're showing them. So it's show not tell on what works. So I see a lot of nonprofits doing that as well. That organization that I was part of, that's what we did, is we took it as an opportunity to share about the how nice it would have been to know who that person was. If anybody has done this for us, we would love to talk to you and hear more about your interests. We'd love to have some notification about that. If this is something you're interested, this is hugely helpful for us. So using those gifts to leverage gifts is another opportunity that folks have. And I know we're like just on the end of time, and folks have been sending questions in along the way. So I'm going to put up our thank you slide that has our contact information. If you want to reach out to either of us, we're of course happy to answer questions or chat further. As I said, McKenna and I in our free time like to talk about planned giving, so we're always happy to have these conversations and really wish the best to all of you and the nonprofits that you're working with, because I truly do believe that this transfer of wealth will result in an increased amount of charitable giving. And it's a matter of how do we position that and how do we position the nonprofit sector to be ready for it. And making sure it's not just the largest organizations that are having these conversations, but it's the little guys that really could benefit, and the impact that you're having in our community is so important. I don't want anybody left off that list. If a donor cares about you today, they'll care about you in the future.
Elena, there was a question here from Louise that says, in your experience, do more donors make planned gifts in the hope of supporting new initiatives versus ongoing operations?
Great question.
I'll jump in here. I actually tend to see that donors who are making specifically traditional bequests are wanting to support causes that have been around for a while. So in higher ed, people want to put it into an endowment where they know it's going to be there forever, right? We're tying their name to a legacy. And so a lot of times donors want to be supporting one of those foundational things for your organization. So, here at FARF, that would be the David B. Frohnmeyer account, right? They want their name to be tied with the Frohnmeyer name, right? And be kind of making an impact where we originally started. But you do have donors, right, who want to be, more forward thinking than more traditional thinking. And that's okay too. I would just say that most donors that I've worked with lean more towards the traditional model for giving rather than more future.
Yeah. And I think some of that's just because that's what they know today. And so thinking about what's coming in the future, they may not have an idea, or they may be open to giving you that unrestricted gift to allow you to do that.
Right.
Which would be the angle I would take, is
Absolutely.
Encourage them to give an unrestricted gift to allow you to address the most current need, which is a nice way to push that direction. I know that's a hard thing to do, but that could be another approach.
Absolutely.
Okay, well, thank you so much. We're getting to the end of our time. So I just, before everybody left, I also wanted to say, you'll be getting emails from us about, even though we may not be holding some topics and presenters, we are thinking about maybe we would still like to promote some social time and networking. So we're talking about once or twice a month doing a social hour of EVDP, like at the end of the day on a Tuesday or whatever, something like that. Meet somewhere and drop in, catch up on things, but not have necessarily a very specific topic or presentation until the fall again. So, gosh, thanks to both of you for great information. My head is a little spinning, but we did record this.
Good, yeah,
And we have the
just keep
slide deck.
watching it.
So the next couple times the things will sink in here. So thanks so much. We'll be sending you the classic EVDP handmade mugs in the mail, or I'll drop them by. Okay. And really, thanks everybody. And we'll be in touch.
Great
Thank you.
conversation, guys.
Okay. All right, so people will slowly kind of get off here, and then we'll